Welcome back to this special edition of Indianomics. We have been speaking with the creme de la creme of bankers and bond experts and stock market experts on how the CRR hike of 100% of all the deposits garnered by banks between September 16 and November 11th will hit both stock and bond markets. Concluding thoughts, Srini. On December 7th, you can still get a 50 basis rate hike, considering the amount of dislocation in both growth and inflation. If that were to happen, how would you look at bonds from here to now and beyond?
See, I think we'll have to look at it from a big picture perspective. You would have assumed 10 lakh crore increase in deposits for the full year. You're almost going to get that over the period from November 9. On top of it, some of this cash which has come in has also gone down to pay down loans. So to that extent, the asset book of most banks is also lower today than what it was a few weeks back. Which means, and it's unlikely that that demand is going to recover over the next few weeks. So to that extent, I think you are having an inflow of liquidity. You are having shortage in asset side, and to that extent, if you extrapolate in terms of what you are likely to do, is that risk-free rate is likely to be lower. And I think irrespective of how exactly RBI does, whether it's 50 or 25 or even more, demand for G-Secs is going to continue to be reasonably robust, and that has the entire thing of this measure yesterday. I agree with what Anand said in terms of we need more clarity on what their thought process is. But I think they had no option, because on Monday you could have had a demand in reverse repo of another 1.5 lakh crores, and then whether they have the securities. And to that extent, they need to take away that liquidity quickly and then give themselves some time to come up with some of the other policy initiatives, which I presume will happen in the December policy review. So I think GSEC is well supported in the current market environment.
Okay, quickly, I guess we're only a couple of minutes more. Amandeep, your thoughts on if there is a 50 or whatever, a 25 rate cut on December 5th, your view of G-Secs up until December 31?
So, Lata, I think, if you look at the the demand supply position right now in the markets, it clearly does favor a bias towards, a strong buying of government bonds. I think in terms of RBI's rate cut expectations in December, it will be, in my view, decided more by how rupee behaves from now till 6th of December. If rupee does not break out of its previous lows, then I think 50 basis point is what we think can clearly happen. But if let's say rupee were to actually depreciate much faster, then RBI may actually choose to stretch in his rate cuts and actually look at just 25 basis point and follow through with another 25 basis point in Feb. Okay.
Anant, concluding thoughts?
Look, I agree with what Srini and Amandeep said. I think a couple of things would be very useful. And I tend to agree that bond yields and interest rates in general will come off given the nature of the situation, irrespective of what's happening globally. I think what would be very useful is to look at transmission very closely and to understand that things like CRR do impede transmission in a perfect sense. The second thing is, I think in times like this, it's important to recognize that having a healthy amount of surplus liquidity, which is going into reverse repo, would be very useful to achieve that transmission perfectly. It can achieve transmission a lot more than blunt rate cuts can. To that extent, I think clarity from the RBI that the operating principle that they will move under will entail a certain amount of surplus liquidity, at least until such time the situation kind of stabilizes, would be very useful. That will give clarity to the bond markets, in which case tomorrow's sell-off or correction would be just that, a correction. And thereafter, bond yields can stabilize and come down further, along with the rest of the interest rates in the system.
Okay. One quick word, Srini. NPAs, we have completely forgotten that used to be the elephant till November 8th. Does the situation get a little worse for the entire sector this quarter next?
I don't know. We need to wait and watch. Broadly, I would think things don't change much. Only thing we have to watch out is in terms of small borrowers, which is possibly a new twist as far as the tail is concerned. But that's still too early for us to take a call on. And let's wait for Q4 to happen, and then that's when you'll get a clear picture. This quarter is going to be quite quite chaotic and to some extent very difficult to make out in terms of what really is happening on the ground.
Yes, there's enough chaos on the liability side, so at the moment problems on the asset side is not foremost. Well, Parag, Amandeep, Anant, Srini and Vikas Khewani, thank you very much for joining us and staying on with us in this last 1 hour, analysing the impact of the sudden CRR hike on stock, bonds and banks. That's it on Indianomics. Thanks for watching.